Luke, we were just talking last segment about something that you had posted yesterday, the divergence in profit margin when you look at the S&P on a market cap weighted basis versus equal weight. Can you talk a little bit just about what you're seeing there and really what's the driving force behind this right now?
Well, right now, I do think this is a bit of a broader story about the U.S. economy in the short term, but it's also a story about just the longer run trajectory of what markets have been doing over the past, 10 to 15 years, and that is the ascendance and the dominance of mega cap tech companies. These companies have more earnings power and more pricing power than the rest of the universe combined effectively. So what we're seeing is effectively the average company in the S&P 500. What are they facing? If they're not a mega cap tech company, they're facing, a world of a little more consumer uncertainty and cost pressures because of tariffs. And at the same time, consumers that don't have the same degree of income growth that they've had in the past. So that's a bit more of a precarious situation in which to be protecting profitability. If you raise prices, you may lose out a lot on volume. I think that'll be a very fun story to be tracking in the next 3 months. And on the other side of the spectrum, you do have tech companies which are now effectively introducing a lot more AI accessibility and enhancements to their models. These capabilities are trying to be adopted by effectively every major company and every major industry, and they're willing to pay up to do it. And the kind of proof that's in the pudding is even, though you don't effectively expect CapEx to pay for itself in 1 year, you expect longer payback periods for that. If you just look at the some of the biggest tech companies, the hyperscalers, everything they've done to juice CapEx in the past year has more than been made up with in sales already.
When we look at the long term play then for these big AI companies, the hyperscalers, I guess what I'm trying to wrap my head around is ultimately they need to be able to sell their services to all the other companies that are out there. Hey, mom and pop, whoever you need AI in order to do this, all the way up to regional companies that need AI to do something. But those companies still need to make final sales to end buyers and consumers. How does this all work if we're in a really stagnant labor market that could be made worse by AI? Like, how do we reconcile where all of this can be going in the next several years? I kind of tie myself in knots trying to figure it out.
Oh man, I wish I had the perfect answer to that, but that is the exact right question to be asking right now. When you think about CapEx booms, zooming out, CapEx booms generally happen as a result of two to three things. One is a response to an acceleration in consumer demand. Consumers want to buy a lot more, you don't have the capacity to produce it, so you've got to expand capacity in order to meet that demand. The second is a large shock in commodity prices that tends to, engender some supply response, whether that be from oil producers, miners, etc. The third is a policy change, sometimes around big tax policy changes. You do see kind of one-off jumps in CapEx. Right now, we really don't have any of those. I think there's an argument to be made that's been slept on a little that some of the tax changes in the One Big Beautiful Bill Act have made it a little easier to be
Mm.
spending billions and billions more on AI related needs. But what we have right now is a situation in which consumer spending has been decelerating a lot. CapEx has been picking up a lot. And we haven't really had a rubber meets the road point where we've had to choose between the two. Because even as you note, that margins for the average company might not be getting too much better. They're also not getting too much worse, and
Sure.
sales are still going up. So we're still in a bit of a situation where, although consumer spending has been softening at the margins, certainly not off to a great start this year. It has been not been bad enough to effectively pull down the incentive to be spending a lot more to invest in AI. Ultimately, consumers about 70% of the US economy. If you think about what will ultimately happen, the consumer will ultimately win. The consumer, quote unquote, wins in two ways. Either A, all of this spending on AI, all of the kind of associated productivity benefits we're supposed to get down the road, and also just the the increase in net worth that's coming from the market rally being led by a lot of these stocks, either that is sufficient to help juice consumer spending or keep it good enough so that effectively it's consumers steadying up or kind of the capex the floor being built up under the capex that's being met by consumer demand, or it's quite simply that in choosing to have the marginal dollar from corporates increasingly and increasingly go towards AI rather than labor, that you're creating a situation in which the consumer wins by falling down and dragging everything else down with it. I do think that this is the key question that will be coming up as we head through the rest of the year. It's a question of that also encompasses, hey, have was spending just delayed due to tariff uncertainty, or is the kind of real spending drag really something that's getting in train as tariffs more and more work their way through the system, companies work down inventory, and then you get additional rounds of price increases going forward? I think it's a very open question. I'm not sure what the answer is, but I'm sure the answer at the end is the consumer wins.
Luke, so these are kind of bigger long-term things. I want to focus now on just what's been going on the last week, because it's been kind of an odd week that I'm trying to make sense out of here. Pretty much ever since the Fed meeting last week, we have a Fed meeting, and then after hours, you get Microsoft and Meta that have blowout earnings to the top side. They're through the roof. Stocks open the next day positive, can't hold their gains. The S&P ends up down for the day, and then Friday we get kind of pukey with a bad jobs report. So it looks like we're heading for a leg down potentially. This week, no major news aside from, I guess yesterday, maybe some of the tariff exemptions for semiconductors, but this market feels like it doesn't want to go down now. What is going on here in this last week? Because I'm having a little trouble making sense of market action here.
Join the club. Join the club. I do think that a big catalyst, a big reason for why markets seem to rebound very quickly is that if you look over the past 10 plus years, you can zoom out to make sense of what's happening in the near term. I think this is one of those examples. Dip buyers have not ever effectively been that punished. The only year you could argue in the past 15 or so where that's really been the case is 2022. We've seen that when there's policy changes that are seen as negative, those will be reversed. So a negative catalyst on the trade front, for instance, seems to get watered down if it's judged to be doing sufficient damage to the forward outlook for stocks. We've seen that through the first week of April. So we have a situation in which there's a Pavlovian response to be buying the dip because you aren't punished. Hey, if you continuously get rewarded for the same behavior, you'll keep doing it. It's the same way if
Sure.
AI companies get rewarded for spending more and more on CapEx in the form of both sales and their market value going up, they're going to do a lot more of it. If people get rewarded for buying the dip and there is this habit of doing so, the direction of travel will be to do so until there comes a sufficient time where you're punished for it. And I believe you can continue to make the argument that what the U.S. economy is really seeing is just a slow slowdown, a moderation in growth, and that there's no real near-term cliff to fall off of. The idea that job growth should be going down a lot because labor supply has decreased a lot, that consumer income growth, once you include transfers, really isn't that awful and is decent to support the ongoing expansion of consumer spending. You can fall back on these fundamental arguments to justify it, but in the end, it's what the behavior that you're really rewarding is that, hey, the last time I did this, it worked, and it worked the time before that, and the time before that, so I'm going to do it again.
Fantastic. Luke, appreciate you joining us today, and thanks so much for the time.
A pleasure to be here. Thank you.
That is Luke Kawa, the markets editor at Sherwood News.